Hi, James Good here with an on-the-money stock market update for the 13th of August 2012. Now, since late last year, I've built my shorter-term views of the market around two solid long-term structures. First, the idea that 2012 would prove a binary one for stock market returns. We'd either see a big gain or a big decline with no fudge or muddling through. Now, I wrote this up last November in a post called The Year of the Cat. A later study of the unusually smooth move up in January then reinforced that view with similar historical scenarios either showing an average 18% gain for the S&P over the next 12 months or an average 18.5% decline. So it's in that context that I came across the second major technical concept of the year, which was the emergence of a classic three peaks and a domed house pattern, which I wrote up in May. Now, this is an extremely bearish price pattern with an incredible risk-reward ratio for trading purposes, and it's shown up at the end of around half of all bull markets in the Dow Jones over the past century. If you've not yet read that post, can I suggest you do so? You might find it worthwhile because the formation now seems to be in its final stages of construction. And I thought I should take time to go over what we might expect to see if the pattern conforms to its 16 historical precedents. So until now, we've had to consider two scenarios, one in which the S&P topped in April, which I've illustrated in red, and one in which it didn't, shown in yellow. In the red scenario, we were due a rally into point 27, below the highs, followed by a hard, strong sell-off, bear market or a crash which takes prices at the very least back to the lows at point 10 at the October lows of 2011. The yellow scenario, which I tended to favor, suggested that that April wasn't the peak, just a teaser before the final high, which would be formed later in the year. And it's now looking very likely that we are going to hit new highs, at which point either the pattern will play out roughly in the manner that the yellow scenario here suggests, the schematic, or the Bernanke put will triumph, and this will be the first failed three peaks pattern in the history of the modern US stock market. Now, researching the 16 prior instances since 1923, I came up with two rules of thumb for timing the peak. First is the length in calendar days from point 14 to point 15 here is very often remarkably similar to the length of the move from point 20 to the ultimate top. And that allows you to set a target date. And I found that 11 of the 16 patterns this century in the Dow topped within a 25% window either side of that target date. Now, in our case, the S&P began its rise from point 14 on December the 20th and peaked on April the 2nd, 105 calendar days later. Now, assuming we make a new high in validating the red scenario, which I showed you, we'll then be looking for a new high approximately 105 calendar days after point 20 in the pattern, which will be confirmed at June the 4th, which would give us a target date for a top in the S&P 500 at point 23 of Monday, September the 17th. The window of 25% either side of that date gives us a range from August 22nd to October the 13th. Now, that might seem wide, but I did discover another tool which can help us. Using a standard MACD momentum indicator, in no previous instance did a bull market high in this indicator coincide with a peak in the stock market. In other words, momentum topped before prices topped, which is to be expected. So if the market continues to rally and the MACD rises to a new bull market high, we can be confident the market is not yet ready to peak. But a divergence between a higher high in prices and a lower high in the MACD, especially if it occurs within this window, will signal the possibility that we're close to the very top of this market. I'll be updating the progress of the pattern in these pages. Stay tuned.